everyone. Thank you very much for joining us today. My name is Victoria Hatherick. I am editor of Argus Media's European Emissions Report, which focuses on the EU and UK ETS markets. And today I have the pleasure of moderating a panel for you on a way forward for the UK ETS. So we've got an excellent selection of panelists for you here today from across the board of stakeholders who are going to take you through some of the changes that we're expecting to come up in the market and a general outlook for the UK ETS. It's a scheme that only began in 2021, relatively new market in that sense after the UK had to leave the EU ETS after Brexit. But it's already evolving a lot. So without further ado, I will introduce our panelists for the session. Please welcome Rachel Armstrong, who is Director of Industrial Decarbonisation and Emissions Trading at the UK's Department for Energy Security and Net Zero. Raul Rosales, who is the Strategic Lead for Industry Engagement at King's College London's Net Zero Centre in the Department of Engineering and leads its carbon markets practice research. Alistair McGurr, Group Head of Policy and Advocacy at SSE. Vanika Chawla, Legal Senior Manager at Climate Asset Management. And Carlo Di Giacomo, who heads AFME's work on commodities in London. Thank you all so much for joining us today. So I thought, Rachel, maybe we could kick off with you just to give a bit of context for our discussion for those of us in the room who perhaps don't follow the UK ETS as avidly as the rest of us. If you could just give us a bit of an overview of what the government is planning to do to expand the scope and the ambition of the UK ETS.
I'm delighted. I mean, obviously horrified that somebody might not be closely detailed following what we're doing. But I have this great privilege to lead the civil service work on the UK emissions trading scheme. And we ended up building our own courtesy of Brexit, right? So where are we now? When we left the EU ETS, we increased our ambition by 5%. So we adjusted the cap to be 5% more ambitious than the EU. I would say that we are now at comparable levels of ambition. And the reason that I would say that is because after extensive consultation last year, we have published a government response and we have adjusted the cap to be consistent with our net zero strategy. So this is a really important thing, because if you think about carbon budgets as a finite non-renewable resource, then you need to make sure that the policy and the emissions trading scheme itself is consistent with your declared strategy. So this is a really big deal, right? I mean, I appreciate that the EU also has plans, but this was a really significant piece. And we also, I think, and this is because it's so important to have a pricing signal, we have got a long-term pathway set out. So not in beautiful technical detail about how you would do it, but we have got political agreement and declared intent to legislate to perpetuate the market out to 2050, right? Now, if you think about that as the way that the covered sectors will naturally decrease over time, because they will be decarbonising because it's a hard cap. This does mean that you have to go, what does that market look like in 2050? Yeah? And this is also where I think it's really important that, of course, we have aspirations to increase to coverage to new sectors, right? And explicitly, to answer your question about what are we doing next, we are doing domestic maritime next, and we are doing energy from waste. Now, neither of these things is an easy thing to do. If you think about energy from waste, this is also talking about how do you reduce the actual absolute amount of waste, and that directly interfaces with your population. Okay? So this is really a careful consideration about how do you use market mechanisms to do pricing in a way that incentivises and enables the decarbonisation routes. But to get to 2050, we actually think that we should also include engineered greenhouse gas removals And potentially, we are going to consider high quality, and I don't just mean ISO standard, right? When I say quality, I mean permanent assured removals, right? So genuine negative emissions, because we see it as a long-term single market, right? And that matters because you don't want a carbon signal on price as a direction of travel that doesn't have longevity. And I appreciate that people would like free allocation policy and other items like that to be there in much more granular detail and much more confidently and way past 26 to 2030. But these are things that are difficult in the kind of quite volatile external environment around us. But it is about investability. So that clarity that this is the direction of travel, that we structurally see carbon pricing as part of the most efficient ways of getting there. And we're very, very happy that together with the ETS and carbon price support, we've backed out coal, right? This is a major significant achievement in terms of what pricing, carbon pricing can do for your economy as part of the energy transition and building a thriving net zero economy. The idea here is not to deindustrialise, it is to decarbonise and to build a new thriving environment for our people and our jobs and our communities. And that's why I'm here to talk about it, because I think it's really exciting. It's difficult. We get questions from everybody about the price is too high, the price is too low, right? So this is about persistence and being stable and having the right control mechanisms to be able to ensure you have a high quality functioning market. So we are also consulting on that. So we've just done free allocation policy review, we've just done market stability. Those two have closed, so we will be doing government response. We are doing, coming out soon, is what happens next with maritime, what happens with energy from waste, and what happens with greenhouse gas removals. And the greenhouse gas removals will have more detailed consultation to follow, because the evidence is not sufficient clear yet.
Thank you for that very comprehensive overview of what's going on. So loads that coming up to be changed in the market. You mentioned there the greenhouse gas removals potentially being integrated into the market. Perhaps I could turn to you, Raoul, to speak a little bit about your view on, is this a positive step for the UK ETS and also for carbon removals themselves?
Okay, good. Thank you. Thank you very much, and thank you for inviting me to attend this European Climate Summit with IETA. I think this is fantastic, a very good initiative. Of course, I fully agree that about the greenhouse gas removals, but I want to say that, first of all, the future of the UK ETS and the future of the global carbon markets in the space of the UK is through the expansion to some voluntary markets and the convergence with some specific voluntary markets. And to be very concrete, for instance, with the greenhouse gas removals. No? For instance, I have in front of me the Chapter 7, which is the response to the consultation to Chapter 8. And I spent plenty of time last year working on this and studying this document. And this is a course for evidence on greenhouse gas removals and agriculture and land use emissions. And it says, the authority believes that the UK ETS is an appropriate long-term market for greenhouse gas removals. We intend to include engineering greenhouse gas removals in the UK ETS, subject to further consultation, a robust MRV regime being in place, and the management of wider impacts. So this is quite interesting, and I really believe that the future is going through that way. For many reasons. It will increase the market, this kind of convergence, it will provide more transparency, more liquidity, and it will provide the trust that investors as well need, and at the end of the day, we will be building up a market infrastructure as well. I would like, in the context of the greenhouse gas removals, also the government, the authority, who is with us now, okay.
I'm the chair.
Okay.
I have to agree with other
Sorry. Good. That's a good point. They recognize that the Woodland Carbon Code is a good way for the expansion of the UK ETS towards the greenhouse gas removals. In that context, we made an assessment, quantitative assessment. Last year, we spent a whole year working on this, working with Imperial College Business School, King's College, and with the instrumental contribution of Foresight Sustainability Forestry, which is the first carbon credit fund listed in the London Stock Exchange under the voluntary carbon market designation of the London Stock Exchange Group for voluntary carbon markets. And an expert, this is the only asset manager in the world investing in this kind of assets in forestry in the UK. And we need the business case of making an assessment, quantitative assessment about what would be the impact, on the wood and carbon unit, which is the name of the carbon credits coming out from the wood and carbon code, or the forestry carbon markets in the UK, in the likely inclusion or admittance, not integration, of the wood and carbon code into the UK emission trading scheme. When we did this kind of quantitative assessment across the whole year, last year in 2023, the wood and carbon code in November was about 28 pounds per ton. If this, according to our quantitative assessment, based in real data from UK ETS and wood and carbon code, and in real data as well from Foresight Sustainability Forestry, 4,500 hectares of land across the UK, England, Wales, and Scotland, the impact in the pricing would be huge, with an increase from 28 till at least 41, 47 pounds per ton immediately afterwards, and by the end of this year, about 74 pounds per ton of the wood and carbon code, in case of that kind of admittance. I say that because we need to talk about numbers, about figures, and about what will happen. And I say that because the pricing of the carbon credits is all about that. We need a very high price, and in addition, of course, to the high quality of the carbon credits. In this case, with the prestige of the wood and carbon code, which is the standard in the UK for the woodland creation and these kind of projects, backed by the UK government with an international recognition and so on. And for investors, it's all about the pricing and the returns. But what is more, in our study, in our policy paper, we show the evidence as well that the unlock of land as a consequence of increasing the pricing would reach at least 26% of land across the UK, the 3 countries, would be unlocked for afforestation. It will help as well in terms of carbon sequestration. I have plenty of figures about that. So what I mean is that this admittance or this of the woodland carbon code into the UK ETS, it would affect. So we don't have any doubt that the expansion of the UK ETS through some voluntary markets, the convergence, this kind of inclusion, it would be a very good price signal in terms of the price discovery, which is what investors are looking at as well, and exchanges as well. And it will improve as well all the key kind of risk management practices, and of course, it will reduce the cost of MRV and will help in this kind of a standardization. Something different that we can leave for afterwards for the discussion is about linking this I mean, with the UK ETS, with the EU ETS afterwards, after this kind of admittance or inclusion, because we need to look at what the EU is doing in terms of the EU ETS with the forestry markets as well. Okay, because we need some kind of standardization in that way and not to have any kind. But I am very optimistic. I want to finish with this part saying that any kind of technical issues that there are, or in terms of differences between both systems could be sorted out if there is a political will to do that.
Thank you. Thanks very much, Raoul. And we'll definitely come back to the question of linkage later. I think that's a very interesting topic for this market. But first, I'd like to turn to Varnika. Oh, sorry, Rachel.
Can I just say something? Because there's a really important point in here, right? So the concept that nature-based solutions at $5, $10, $15 a tonne are going to be widely available at any kind of scale needed, that are genuinely permanent. And when we are talking permanent, right, you're talking about the opportunity cost of that land for in excess of 100 years. The idea that that is cheap, I would like to strike from everybody's minds in the room, right? So that is not a cheap thing to do. And I think the And we thought about this quite hard, right? Because if you think about what engineered removals look like, and we're going to have to do some engineered removals, right? There is no way around this. Think about what DAX costs, right? That's north of $300 a tonne. You can do biochar somewhere 230-ish, right? This stuff is really expensive, so you have to be very careful with your market dynamics about dilution effects in the opposite direction of making things cheaper by introducing trees. So you may reasonably expect that we have some evidence that it is not cheap.
Thank you for that. So I'll turn now to Varnika just to give a bit of your perspective on how you think all these different changes that are going to be coming into the market will affect UK ETS prices.
Thank you, and thanks for already the very interesting conversations here. Lovely to be a part of this panel. By way of brief introduction, I'm Varnika Chawla. I am a legal manager with Climate Asset Management, and as you can probably tell from our name, we have a mandate to invest in natural capital and nature-based solutions at scale across developed economies in Europe, North America, Australia, New Zealand, but also emerging markets in Africa, Asia, and Latin America. And one of the points that you've made just now, Rachel, on nature-based solutions not being cheap and that they do come at a cost, I 100% agree with that. To ensure high-quality, permanent, additional carbon removals through nature-based solutions is a massive task, but it is not inachievable. And more than 30% of the world's emissions reductions can be accounted for through nature-based solutions, with that number only increasing. But that aside, it is really good to see that the UK government is actively considering greenhouse gas removal technologies through both engineered solutions, but also looking at high-quality nature-based solutions. And to see the alignment with the net zero objective of the UK. So I know Rachel's touched on many of the reforms that were announced last year, and I'm sure they've been keeping you very busy through all of the consultation processes that started at the beginning of last year. But I think just very broadly to set out a summary of the reforms that were announced, there is a cap which is consistent with the net zero targets and consistent with the 68% emissions reduction goal by 2030, with achieving net zero by 2050. I think one of the concerns there that we've already touched upon as a panel is the speed and the trajectory for reduction in that, and the need to look at a holistic solution, not just look at it in a siloed perspective of certain industries, but look at it more widely and examine it in light of carbon leakage mechanisms, which tie both with the free allowance review that was done last year, but more broadly with the recent announcement of the UK CBAM and the expectation of public more generally to be linking the UK ETS with the EU ETS. But as of now, there is quite a considerable price difference between the UK emissions allowances as opposed to the EU allowances, and I think just missing that opportunity of trying to link it with the EU ETS could be a big miss for the treasury of the government, because a lot of the revenues would then flow into Europe, which could have been used towards investments in decarbonisation within UK itself. And I know, Alistair, you're going to be talking a bit more about that linkage and the need for it, but just briefly looking at a few other reforms that have been announced. So in line with achieving these targets, I'm aware that some additional allowances have been released from the pots for 2023 and towards 2024. So there will be an additional 53 million allowances to ease the pressure of the hard cap that's been announced. And then the free allowance review, we are very much looking forward to seeing the government response to that consultation that ended recently. There is broadly more alignment with the EU in terms of the sectors that the UK is looking to cover, in terms of the phasing out of aviation free allocation as well. I know we discussed that this morning on some of the other panels. And then, as Rachel pointed out, I think a lot of work set out to bring in domestic maritime, which corresponds with what the EU is looking at in the ETS, but also more broadly looking at waste and waste incineration to be brought in by 2028. So I think a lot of this will affect market prices. Hopefully some of them will be aligned with what we see in Europe, but there is definitely an opportunity here to not miss out on the fiscal treasury's budget in terms of alignment with the wider decarbonization strategy. Thank you.
Thank you. So we've been seeing this relatively wide discount of the UK ETS to the EU ETS for a while now. Alistair, maybe I could turn to you next. Some of the control mechanisms that Rachel mentioned that the government are looking to potentially bring in for the UK ETS, do they have the potential to kind of support the market in any way? Do you think that, for example, the supply adjustment mechanism could do for the UK ETS what the MSR did for the EU ETS?
I suppose there's a short answer to that, but I'll maybe kind of start with a bit of an introduction to kind of our kind of perspective. So I think as an operator in both the UK ETS and the EU ETS, we're having to think about both markets. We're also having to think about how CBAMs might interact at our operations. So we are an electricity generator in both the UK and Ireland, which comes with its own challenges. And obviously plays into kind of CBAM dynamics. But in terms of, so back to your question on the kind of supply adjustment mechanism. So firstly, we welcome that kind of one is being brought forward. However, kind of whilst it's expected to mirror the EU ETS in some way, shape or form, I think other parts of the scope look fairly similar to the EU ETS, maritime, energy from waste, for example. But kind of the kind of differences between kind of when the MSR came in and when the SAM is being kind of introduced now. Ultimately, there's a kind of question about kind of what did the MSR do. So the MSR came in and basically kind of supported prices by inserting scarcity into the market, i.e. kind of bringing forward scarcity so that kind of prices rose to the marginal abatement cost. The UK ETS is in a slightly different situation as it is now. So it's not about kind of signalling scarcity in the market. There is upcoming scarcity. You know, actually, the market in the UK is getting very, very tight. But so to answer your question directly, will it assist kind of low prices now? Probably not. I think it might have some value in respect of providing long-term clarity about how the supply adjustment mechanism might work. But it's more of a kind of how does it protect the market stability in the future? There is a risk that it can exacerbate the problems we see today. So kind of if you were just looking at kind of that scarcity coming up in the UK system, you might actually, if you get the SAM design wrong, that actually you end up going the other way and actually kind of removing that scarcity. So it's kind of a lot of care needs to be given about the design of the supply adjustment mechanism. But in terms of will it resolve the kind of sustained low prices we're seeing at the moment, that's not something that we would kind of see as happening. I think then the kind of obvious question after that is, why is this near-term scarcity in the UK ETS not feeding into prices today? And so kind of can't speak on behalf of the market, and obviously as an operator can't kind of give precisely kind of what everything is going on, etc. But ultimately, kind of you would assume that speculative buyers would see a buying opportunity now to kind of take a return on that scarcity value in the future. But so why are they not doing that? I mean, there are some things across that are common across carbon markets. So interest rates being going up, macro politics playing into kind of issues. But actually, in relation to the UK ETS, there are probably two specific issues which are kind of playing into kind of price dynamics we're seeing at the moment. The first is political risk. Ultimately, in a national ETS, you are much more exposed to domestic politics than you are in a European or the EU ETS, because in the EU ETS, if you're holding an allowance, a country, let's say, decides to leave the European Union, that allowance has a value. You can go and sell it to someone else who can use it in another national market. So in that sense, the UK ETS is exposed to a lot more kind of domestic politics, and we have an election coming this year. The kind of second point I'll mention is liquidity. Obviously, the UK ETS is smaller, so for speculative actors in the market, they'll be thinking about how quickly can they exit a position if things go against them. And actually, in the UK ETS, liquidity is going to be a challenge. So, those problems are not going to go away anytime soon. I mean, the election might give us at least 5 years, potentially, of clarity about when the next disruption of politics might come along. That's obviously no guarantee that any government in the UK will last 5 years. But which then comes back to the question of how do you actually address low prices in the UK ETS today? So, I mean, we, as kind of alluded to by Varnica, we'd be strongly advocating for a link with the EU ETS. And we think that actually, whilst we've had several years of quite, what's the way to describe it, kind of difficult relations with the EU, I think actually next year, kind of, if the polls end up kind of being correct, change of government prospectively, the EU CBAM coming, there's an opportunity to maybe from the political level, I'm not saying kind of at the government official level, at the political level, there's a much more kind of, there's a bigger opportunity to actually start, or at least from the UK's perspective, to signal that it wants to start linking negotiations. And we think that should happen by spring next year. We'd also argue that one of the reasons why linking might be rational, and we'll come back to this as well, is the CBAM. And the CBAM coming in 2026 is obviously going to be kind of creating all sorts of political challenges. One, UK exporters, although technically importers into the EU, having to pay into the EU budget. That's a headline that writes itself in 2026. That could be funding the NHS instead. But there's kind of the issues around revenue, and to touch on the negative emissions point, where are these revenues flowing? Where's the most value for them to flow to help decarbonise the economy? Our argument is there's would actually be better to flow into industrial decarbonisation. So whilst negative emissions do need to be coming into the ETSs at some point in the future, we think actually it's quite important there are revenues to support industrial decarbonisation. And lastly, obviously, Northern Ireland is always going to be a challenge in respect of what happens between GB and kind of EU trade policy. So kind of having a linked system will actually help you address that. But the kind of point that we'd make is, as an interim step, as a kind of argument of let's encourage, or let's start linking in spring, or let's initiate the view that the UK wants to start linking in spring next year. And by the end of the year, which is a pretty important COP, the next, or the end of the next kind of ambition cycle review, that actually if the UK and the EU have started ETS negotiations, there's a strong narrative internationally about how that can exhibit close collaboration between near neighbours, and hopefully then encourages others to kind of do the same, and actually provides an example of where the CBAM can be disapplied. But so I know we'll come back to these, but I thought I'd kind of get them out front now.
No, that's great. Yeah, thanks very much, Alistair. And I was planning to move on to the question of linking now, in fact, so that works very well. Carlo, maybe I can turn to you now to speak a little bit about your perspective on linking. Do you see that as a positive approach for the UK ETS?
Sure. So thank you, Victoria, and thank you, everyone. Again, this question of linking is the one that has taken center stage, I would say, right now. But I'll address it from maybe a financial services perspective, and that is, of course, that two of the risks that the UK ETS authority has identified as major in the development of the ETS, of course, are liquidity and volatility of the market, and that is largely due to the fact that to the size of that market and to the availability of allowances. So if we think about the EU ETS, again, that covers around 10,000 installations as opposed to several hundreds in the UK ETS. And of course, a smaller market is less liquid than a bigger market, and then when you have the sum of two markets will be even bigger than its two parts that make it. But what we want to say is that basically a joint ETS, a larger ETS, would attract all those non-obligated entities, such as financial institutions that do see the potential in the market, and would also help companies to actually better hedge against the price risk of the allowances that they purchase for their compliance purposes. So going back a step, the obligated entities, of course, they are on the buy side. What they do is that they need longer contracts, they need forwards and future contracts to actually manage and hedge against the price risk of their allowances. But to do that, in order to do that, they do need counterparties, the sell side, that are actually able to take the opposite side of the transaction. And that is where the financials or other operators with hedging and trading capabilities come in. And now, the larger the scope of the UK ETS, the more there will be, the more the banks, for example, will want to participate in the market, and and therefore increase both the liquidity, but also in the primary market, so at auctions, but also in the secondary markets. And again, a more liquid market makes sure that companies are better able to manage their risks. Now, I think that there are two messages that would be the main messages. One, again, joining the ETS would allow for more efficient price discovery, and again, make trading easier because of the larger pool of buyers and sellers. And what Alistair mentioned, which I think is very interesting and one of the most important themes now, is that UK exporters of high carbon products would then avoid having to pay the carbon tax, which stems from the CBAM, which now entered its transition phase. Not to mention, I would even dare to say that the EU and the UK would again reaffirm their role as climate leaders. And I would also want to mention one, which is an unusual clause, I think, in the Trade and Cooperation Agreement between the EU and the UK, that actually states that the two parties would give serious consideration to linking their carbon markets, which I'd like to interpret as a sign of goodwill from the two jurisdictions, and we'll now see if our message would definitely be that to enter into negotiations, resume talks to make sure that this linkage can actually happen.
Thank you. Thanks, Carlo. Rachel, you did talk a little bit on the CBAM panel earlier about this, the clause in the agreement and the general view of the UK around linking to the EU ETS. So I won't make you repeat everything you've already said, but one of the things you highlighted earlier was this question of the timeline of a linkage. So, for example, when the EU linked its ETS to the Swiss ETS, that in the end took about 10 years of negotiations, which were wrapped up in all sorts of other political issues that weren't anything really to do with carbon markets. Is this timeline risk a big concern for the UK?
So, first let me tell you that we are aware of the precise wording in the TCA, and we always do what we said we would do. So we are explicitly considering what it would mean and what it would take, because it's very important that we can always provide informed, transparent decision-making to our ministers. Right? That's a different thing from it being inherently obvious that this is the thing that must happen. Right? And of course, for there is a negotiation component in here, and negotiations require partners on both sides to want to do things. So I think there is just a consciousness on the timing piece that says this is extremely important to some parties, and for other parties, and I don't mean the governments, I mean in terms of the total prioritisation sets, it sits in different orders of hierarchy around how much willingness and time things would take. So I think if you had political will on both sides to really push this, you can do things quite fast. but quite fast is still on a political time horizon, right? And that is something that I think we have to be very cognizant about. ETS is not paper policy, right? You're actually running a market. You have to do regulation. You have to think about what's actually happening in terms of your regulators. Once you've done your, this is what we're going to enshrine in law, then you have to do now what actually happens, who are the people who are going to do that and stuff. And I'm very cognizant of the fact that when we talk about linking, there's all of the beautiful economic theory, which I completely agree with. Economic theory is very clear. But you still have to go, actually, what would it take to get this done? And that's why we are even having the conversation about, is the timeline an executable timeline? Because you can't be not serious when you're looking at having an investable but politically convened market, that it has to persist and it has to be deliberate and it has to deliver on time. And I think it's just that consciousness that we also need our political leaders to be clear that anybody that we want to link with, if you're going to negotiate, you have to include that negotiation time.
Thank you. Raoul, I know you mentioned linkage earlier. I don't know if, did you want to come back at all to that?
Absolutely, and I fully agree with those comments, Rachel, 100%. Because when we are talking about carbon markets, we are talking about, they help in decarbonization, of course, this is obvious, but also they help to mobilize funds and as a source of fundraising as well. This is a source of income for governments through the ETS, with no doubt, but they also help in the energy transition. So, and also, we have to be aware that we need to address this with an investors and capital markets approach. And investors and markets, they don't wait. They don't wait. For instance, I would like to mention to learn, for instance, what happened in New Zealand. New Zealand last year, there was a consultation from the New Zealand government about, because in New Zealand, the forestry market has been embedded in the New Zealand ETS from its inception. No? So, and there was a consultation in May, June last year in New Zealand, and the consultation was not very clear. And because of that kind of lack of clarity for investors and for markets, the New Zealand carbon unit dropped by 35% in a few months, and it recovered in October last year when there was clarity about that. What I mean is that we have to be very careful with the messages to the market, because we are talking about capital markets. We are not talking about regulatory discussions or whatever. We are talking about the real business. We are talking about the real economy, and we have to be very clear about that. So again, capital markets approach, and bear in mind that we are talking about fundraising as well, and something real. But in terms of again, coming back to the future of the UK ETS, I think this is going through the linkage with the EU ETS. And I would like to make reference to what Carlos says, because I have in front of me the Article 392 of the UK Trade Cooperation Agreement. And it says, the parties shall cooperate on carbon pricing. They shall give serious consideration to linking the respective carbon pricing systems in a way that preserves the integrity of these systems and provides for the possibility to increase their effectiveness. So from the very beginning, of this agreement that was enforced in May 2021, as you know very well, it was considered the linkage with the EU. So I want to say three ideas. The linkage, or in one way or another, of the UK ETS with the EU ETS will provide transparency and liquidity to the market. That's absolutely clear. Also, it will help in the process of this kind of MRV processes in terms of reducing the cost, because we need standardization as well, okay, in that way. We have to be pragmatic. The second point, it will increase the demand for buyers and sellers. This is something that we need in carbon markets. And the third point is that the only way for a full exception from CBAM, which is one of the big topics of this panel, and all what we are talking about, and for the next 2 or 3 years as well, the only way for a full exception is, there are two ways. One is the full participation in the EU ETS, like Liechtenstein, Norway, and Iceland, or the full linkage, like Switzerland. One of these two ways. Okay. I mentioned at the beginning there are some technical issues in terms of the pricing mechanisms that we can discuss with detail if you want. But as we mentioned as well, if there is a political will, there is a way to do that. And my message to the government, whoever the government is in the UK, and also to EU governments as well, is, please guys, help. The only thing you have to do is maybe, I was going to say, sorry, not to do anything, but not to make any problems. Let them, this be market-driven, so let the market work properly. So everybody wants to do this and to make it happen. So.
Thank you. Alistair, I think you wanted to add something.
Yeah, I just wanted to come back in a couple of points of linking, actually, and do appreciate serious consideration has been given. Continually, about how seriously. But so, and this, certainly this is not a kind of push towards government officials. This is I think the point you made there, political will, right? So it's a kind of political decision that has to be made around linking. We're still in the Get Brexit Done government. The Commission's still got the mandate that it has from kind of its current kind of point. Winds of political change can happen over kind of 2 elections in the UK and the European Parliament. So hopeful, but I'd maybe put a kind of stretch target on what an ETS linking timetable could look like, because actually an ETS linking legal document is a fairly light touch thing. It ultimately says, we see your market, we agree to link. If you make a change, let's have a meeting. If we don't like the change, here's how we might exit. That's basically it. That's the kind of heads of terms of most linking agreements will be that, basically. The challenges, and this kind of comes into maybe why Rachel's making slight faces towards me, but are things like, it's the boring stuff, it's the IT infrastructure. How do you get 2 registries to talk to each other? It's supply adjustment mechanisms. How do you, what are they measuring? How do they operate in coordination? Those are difficult discussions. But with the right political will, I think our perception of what a timeline could be is, as I kind of mentioned, starting in, or at least UK signalling wants to link in spring 2025. The EU saying, okay, let's start negotiations at the end of that year, with the right political will, get it done and dusted within a year. So obviously technical things still to work out, IT registries talking to each other, et cetera, et cetera. So you can actually get an ETS linking agreement in place and operational by the start of 2029. So Rachel might tell me, no, that's not possible, but it's a stretch target. I hear from certain politicians that there is a North Star in certain political agreements they want to make, Labour and their clean energy mission.
Did you say 2029?
It's a stretch target. So you're saying it's not possible?
I think that's not what I'd call a stretch target.
2028? But yeah, so I'll just put it out there. Obviously, one to think about after the election.
Farnika, did you want to add something there?
Thank you. And I would slightly differ from what Alistair has said. As someone who's participated in bilateral investment treaty negotiation processes, I know it is more than just a simple legal text that is required for linking the 2 markets. And so I think an interesting third proposal, in addition to the 2 solutions that Raoul, you mentioned, of either having a Norway-like participation, direct participation in the ETS, or a Switzerland-like structure for full linkage, would be to even consider a partial linkage based on certain sectors which are already aligned, because that, I believe, is a very achievable goal. I think that would lead to more price certainty as well. That would lead to increased demand, generally lower cost of decarbonization, while still allowing the two systems to coexist and be fungible with each other, and allowing the 2 different regimes to focus on certain differences that could be important to them, like the EU is not considering greenhouse gas removal technology, for example, which the UK is. Or the sort of different sectors, like the EU is considering electricity as part of the CBAM, which isn't in scope of the UK CBAM or the UK ETS. So I think at least having that, the UK CBAM, but at least having that partial linkage on the sectors that do fall within scope of both the systems could be a step in the right direction.
Great. Well, we're getting towards the end of our time, so I think I will see if anyone in the audience has any questions.
Can I just,
Oh,
can I
sorry.
just add something?
Yes,
Right?
please
So, as a delivery professional, I find the concept of 2029 is quite a long time if you want something that's going to enable your economy, starting from now, right? So I think that there are challenges around what does stretch really look like, and it's a very interesting concept. I'd have to think about what that would mean if you wanted to do partial linkage, because that feels like you're introducing complexity that you might not need. But I just think there's two fundamental things in here as well, right? Our nationally declared contributions are also distinct now. So that would also have to be structurally part of any linking thing. And so would the clarity around what happens with your revenue. So I suspect there are things that are beyond just the in principle that would really need to get tested fast. And we remain open to linking with other markets as well.
Are there any specific other markets that you've been looking at?
So we look at all of them, yeah? Because we just do think that carbon pricing is a really good thing.
All right. Sorry for the slight delay on the questions, but if anyone would like to ask one, yes, please. Thank you.
Hello, Anthony Lane from Opus and Dow Jones. My question is for Rachel Armstrong, and it relates to your department handing out free allowances to the operators of permanently offline installations. And there are several examples of this in recent years. To take just one example, CF Fertilizers, its facility went offline in September 2021, and so it emitted just 6,754 metric tons of carbon in 2022, but you gave it 488,602 free allowances, worth £38 million. Isn't that, in effect, subsidizing deindustrialization? You talked earlier about wanting to support decarbonisation, not deindustrialisation, but isn't that actually doing just that? Thank you.
So for the perhaps less expert market, I don't know whether you all understood exactly what the gentleman said. He's talking about activity level change. So your free allocation is given on an activity level change basis, and if you change your operations, there is an adjustment after the fact. So the way in which free allocation is given to the eligible counterparties at the moment, they get it in advance of the year in which they need to surrender, so that assists them with cash flow. That is a design feature. Right? Now, it has a design feature which has unintended consequences in the event that when a company closes, yeah, they've received their free allocation in advance, and subsequently potentially, so they would, if they happen to do the timing of that closure very, very well, they could still have just received a year's worth of free allocation, which they are then at liberty to monetize. Yeah? It is something that we have explicitly addressed in a recent consultation and are looking at, because there is a very valid point about if that investment is to support decarbonisation and reinvestment, this is probably completely acceptable, right? And closure is an explicit case of, that's the extreme case, but you could imagine that you're closing down one facility, but you are moving to part of the green economy, you're creating jobs, this is a good thing. If you are willfully taking the allowances, cashing and going insolvent, and you do so knowingly, not as part of going business, that's illegal anyway. But it doesn't alter the fact that we are very explicitly looking at how do we manage this, because those are valuable assets that we just need to make sure are being used in sustaining the economy rather than paying people a golden goodbye.
Sorry, I just had a quick follow-up. The loophole is still effectively there. The loophole is still effectively there. When would you change this at the earliest? What's the earliest date you could change this? Because if an installation went down today, emitted a tiny amount of carbon next year, you'd still be giving it the free allowances next year, wouldn't you? Thank you.
Until we have changed the system, that is correct. But as I said, it's not a loophole. We don't like the unintended consequence, but it was part of the design to enable the businesses to manage their liquidity.
Thank you. Yes. Can we take a question here?
Thank you, and for such an interesting panel. I'm Georgia Berry from Patch. I had a question on the inclusion of greenhouse gas removals and ultimately on more other permanent carbon removals into the UK ETS, and that being on the table. Within the context of alignment or potential alignment with the EU ETS, possible linkage, etc., I was just wondering if you are communicating with, working with, and sort of considering how the EU ETS are thinking about and the Commission are thinking about including removals into the design of it, because we've been sort of party to quite a few conversations where there's very real concern about including removals into an ETS, sort of somehow negatively impacting the trading system and looking at a parallel trading system that would connect to but not necessarily be part of it. So I was just interested if you're actively thinking about how it could, or what sort of some of the negative impacts could be, and within that, as I say, overall broader context of how aligned you're trying to be over the next couple of years, if there is going to be linkage.
So it's a fantastic question, right? So we're thinking very hard ourselves about how would you do this, right? And for the reasons that it is intellectually obvious that you should make things as simple as possible, but not simpler than they should be, right? And that you can't have net zero if you don't have negative emissions. Sorry, you can't, right? So we have to find a solution to this. I think from a linking perspective, it wouldn't be tomorrow anyway. So you could handle, I think that would be if there were genuine concerns around this, because it's a different revenue stream. It's not something that is owned by the government and being surrendered. It is genuinely a different piece. MRV is also quite challenging on this. So I think it's not a tomorrow problem in that sense. So I'm slightly more relaxed about that piece. But it is, it's something that, of course, we are extremely conscious of. Because in order to do a good thing, we should not destroy something that is already functioning very well. And so you have to manage that piece quite carefully.
Yes, just one final question because we're out of time. Thank you.
Thank you. A follow-up question on GGRs. So, Angela Hepworth, I'm with Drax in the UK, developing engineered carbon removal projects from BECCS using bioenergy. So, absolutely delighted to hear about the plans to get GGRs into the ETS. I think that's absolutely the right thing to do. Now, the UK government's got a target of having 5 million tonnes of removals from GGRs in place by 2030. Our target is to have our first unit online in 2030. Revenue from the ETS, depending on how it's implemented, may not be enough on its own to support the development of a GGR project, but if you coupled it, for example, with a UK CFD, then that could provide you with a very investable framework. So I guess two questions around it. Might 2030 be a credible date by which we might have GGRs in the ETS? And can you say anything about where the costs of that might fall, as in between costs on industry or costs or reduced revenue to the Treasury?
So those are all, I mean, from an investor perspective, they're all critical questions, right? I can't tell you anything, unfortunately, about the balance of who pays, right? So if you look at the net zero strategy, you're completely right. There is a significant volume of GGRs that we have to have. And if you aren't talking about the more, the highest end of GGR costs that exist today and available in the world, then you are rate limited by the number of CCS plants that you currently have available, right? So you can see that there are real hard constraints. And when we talk CCUS, I do think we need to talk more about the U, not just the CCS bit, right? Because otherwise you do have physical bottlenecks that are challenged by your build-out rate from an engineered perspective. But yes, that is a conversation that is highly commercial and needs to be properly negotiated because, and I think it also ties into this conversation about what is the Green Book value. So this is how Treasury values CO2 or greenhouse gas equivalents, and what is the market price? Because if you had to pay the Green Book price, then most businesses would not be able to do so. So there is this trade-off of who pays and how is that shared, and how do you really make sure that you have enough carbon pricing that enables competitive business growth, but also real innovation to drive costs down.
And 2030, deliverable?
We might see the first ones.
And maybe there are some lessons to be learned there from what other countries are doing, like the US has its Inflation Reduction Act that it recently published, which does invest quite heavily, enables investment from the private sector into CCUS and CCS as well. So actively looking at tax credits as well to enable such investments from the private sector.
And I think you also have to recognise that all of the different countries have different assets, which mean their decarbonisation journeys can be different. And the UK has significant potential in its subsurface storage capacity, which nobody's mentioned from a linking perspective, but that would be very interesting from if you had linked ETSs and you can do permanent storage, does that actually start to drive scale and drive costs out? So that's also something that we look at quite seriously because we're going to need some CCS.
Great. Well, thank you to all our panellists for your time and for the audience for your attention. And we'll wrap up now. Thanks very much.